They promised riches but delivered ruin. Unmask the seemingly brilliant investment opportunities that were, in reality, carefully disguised financial traps. In the relentless pursuit of wealth, the allure of a smart investment, one that promises high returns with little effort or risk, is almost irresistible. We all dream of that golden opportunity, the insider tip, the groundbreaking technology that will make us rich overnight. But for every genuine innovation, there are dozens of carefully constructed traps designed to separate the eager investor from their hard-earned money. These aren't always outright scams. Sometimes they are legitimate-sounding ventures that, upon closer inspection, reveal fatal flaws, hidden risks, or a fundamental misunderstanding of market dynamics. They promised riches, but delivered ruin. Today, we're going to unmask the seemingly brilliant investment opportunities that were, in reality, carefully disguised financial traps. We'll dissect the common characteristics, the psychological manipulations, and the red flags you must learn to recognize to protect your portfolio. This isn't about discouraging ambition. It's about empowering you with the knowledge to distinguish between genuine opportunity and dangerous deception. Prepare to challenge your assumptions about smart money and learn how to spot the wolves in sheep's clothing. Let's expose the anatomy of a financial trap. Our first trap is the overhyped technology with no clear business model. In the age of rapid innovation, new technologies emerge constantly, promising to revolutionize industries and create unprecedented wealth. Think of the dot-com bubble of the late 90s or certain segments of the crypto market today. Investors pour money into companies based on buzzwords, grand visions, and speculative projections, rather than on proven revenue streams or sustainable business plans. These ventures often have impressive prototypes, charismatic founders, and a compelling narrative, but lack a clear path to profitability or a viable market for their product. The investment is driven by FOMO, fear of missing out, and the belief that this time it's different. The red flags include a focus on potential rather than current earnings, a lack of transparency about financials, and a reliance on continuous funding rounds rather than organic growth. When the hype inevitably fades, or the promised technology fails to materialize into a viable product, the investment collapses, leaving early investors with worthless shares. The lesson: always look beyond the sizzle and demand a clear, sustainable business model. Next, beware of illiquid investments with unrealistic returns. These are opportunities that promise exceptionally high returns, often with a guarantee, but come with severe restrictions on when and how you can access your money. They might be in obscure real estate developments, private placements in unproven companies, or complex financial instruments that are not traded on public exchanges. The trap lies in the lack of liquidity. Once your money is in, it's incredibly difficult to get out, especially if the investment sours. The high returns are often a lure to compensate for this illiquidity and the inherent risk. Red flags include promises of guaranteed double-digit returns, pressure to invest quickly, a lack of independent third-party oversight, and complex legal documents that are difficult to understand. Many Ponzi schemes disguise themselves as illiquid, exclusive investments. Always ask, how and when can I get my money back? If the answer is vague or involves significant penalties, proceed with extreme caution. Liquidity is a form of safety. While often legal, many multi-level marketing (MLM) schemes can be financial traps disguised as business opportunities. They promise financial independence and entrepreneurial success, but the reality for the vast majority of participants is often significant financial loss. The focus is often on recruiting new distributors rather than on selling products to end consumers. Participants are encouraged to buy large inventories of products, attend expensive conferences, and recruit their friends and family. The compensation structure heavily favors those at the top of the pyramid, while those at the bottom struggle to make a profit after accounting for their expenses. Red flags include high upfront costs, pressure to recruit, a focus on lifestyle and dreams over concrete sales figures, and a compensation plan that is overly complex or relies heavily on recruitment bonuses. While a few individuals may succeed, the business model is inherently designed to benefit the company and the top few distributors, making it a trap for the unsuspecting majority. The most obvious yet still effective traps are the outright get-rich-quick schemes and unrealistic promises. These prey on our desire for effortless wealth and often involve little to no actual work or skill. They promise astronomical returns in a short period, often with little to no risk. This can include everything from dubious online trading platforms, secret real estate deals, or guaranteed cryptocurrency mining operations. The red flags are glaring. Promises of returns that are far higher than market averages, claims of secret formulas or insider information, pressure to invest immediately, and a lack of transparency about how the money is actually generated. If it sounds too good to be true, it almost certainly is. These schemes often rely on a combination of psychological manipulation, fabricated success stories, and a lack of regulatory oversight. Always remember, legitimate wealth building takes time, effort, and involves inherent risks. Sometimes the trap isn't the investment itself, but our own emotional investing and FOMO-driven decisions. The fear of missing out, FOMO, on a rapidly rising asset, or the panic during a market downturn, can lead to irrational and costly investment choices. We see others getting rich quickly and feel compelled to jump in, often at the peak of a bubble. Conversely, during a market correction, fear can lead us to sell at the bottom, locking in losses. These emotional decisions override rational analysis and long-term strategy. Red flags include making investment decisions based on social media hype, news headlines, or the advice of friends rather than thorough research, and a feeling of intense anxiety or euphoria surrounding an investment. The antidote is to have a clear investment plan, stick to your long-term goals, and avoid making decisions based on short-term market fluctuations or emotional impulses. Discipline and patience are your greatest allies in investing. Finally, even seemingly prudent strategies like diversification can become a trap if taken to an extreme, leading to over-diversification and junk investments. While diversification is crucial, spreading your money too thinly across too many assets, especially those you don't understand or that are of poor quality, can dilute your returns and make it impossible to properly manage your portfolio. Some investors, in an attempt to be safe, end up investing in a wide array of low-quality, high-fee, or obscure products that offer little upside and significant downside. This can be exacerbated by financial advisors who push products that offer them high commissions, regardless of their suitability for the client. Red flags include an investment portfolio that is overly complex, difficult to understand, or filled with products that have high fees and low transparency. The goal of diversification is to reduce risk while maintaining returns, not to simply own everything. Focus on quality, understand what you own, and avoid investing in anything that feels like junk just for the sake of diversification. So the financial world is full of traps, some obvious, some subtly disguised. From overhyped technologies and illiquid promises to MLM schemes, get-rich-quick fantasies, emotional investing, and misguided diversification, these are the pitfalls that can turn a smart investment into a financial ruin. But by understanding these mechanisms, you gain the power to protect yourself. This isn't about becoming cynical. It's about becoming a more discerning investor, a more critical thinker, and a more empowered financial decision maker. It's about recognizing that true wealth is built through knowledge, patience, and a healthy skepticism towards anything that promises too much, too soon. The question isn't if you'll encounter these traps, but whether you will be wise enough to spot them and avoid their grasp. Are you ready to invest with wisdom and protect your financial future?